The most dangerous investor in the room is not the impulsive one, it is the intelligent one who has convinced himself he has figured it out. Every year, high IQ professionals, doctors, engineers, lawyers, systematically destroy wealth that took decades to build. Not through ignorance. Through intelligence applied in exactly the wrong direction. This is the wealth code. Stay until the section on what wealthy people actually do differently, because there is one specific cognitive ritual most of them share that will completely contradict everything you have been told about smart investing. In 1998, a fund called Long-Term Capital Management collapsed, and nearly took the entire global financial system with it. This was not run by amateurs. The board included 2 Nobel Prize winners in economics, Myron Scholes and Robert Merton, the men who literally wrote the mathematical models modern finance runs on. At its peak, LTCM was leveraged at 25 to 1. They held derivatives positions worth over $1 trillion. The Federal Reserve had to organize a $3.6 billion private bailout just to prevent a cascade collapse. These were the smartest people in any room they ever walked into. And they were catastrophically, historically wrong. That is not an accident. That is a pattern. Intelligence does not protect you from bad investment decisions, it makes them worse. Because a smart person does not just make a bad bet. A smart person builds an elaborate, internally consistent, deeply researched case for why their bad bet is actually correct, and then they hold it all the way down. Most finance content will tell you to learn more, research harder, analyze deeper. That advice is actively harmful for most investors. The single most predictive variable for long-term investment success is not IQ. It is not information access. It is behavioral discipline, the ability to do almost nothing, consistently, for a very long time. And that is the thing intelligence actively works against. Let us start with what psychologists call the illusion of explanatory depth. Researcher Leonid Rosenblatt at Yale demonstrated that people consistently believe they understand complex systems, economics, markets, policy, far better than they actually do. Ask them to explain the mechanism in detail and the confidence collapses. Intelligent people are more susceptible to this, not less. Because they have successfully built accurate mental models in their own domain. A surgeon who masters the complexity of the human body carries that sense of mastery into the stock market. The brain does not automatically recalibrate confidence by domain. Then there is recency bias, one of the most financially destructive forces in human psychology. Daniel Kahneman, Nobel laureate and author of Thinking Fast and Slow, spent decades documenting how the human brain assigns disproportionate weight to recent events. What just went up feels like it will keep going up. What just crashed feels like permanent destruction. This is not stupidity, this is a deeply wired survival mechanism. In the ancestral environment, if the river flooded last season, it probably flooded this season too. Pattern recognition from recent events was adaptive. In financial markets, it is lethal. Studies from Dalbar Inc., the financial research firm that has tracked investor behavior against market returns since 1994, consistently show the same result. Over a 30-year period, the S&P 500 averaged roughly 10.7% annually. The average equity fund investor earned around 4.9%. The gap is not the market. The gap is behavior, people buying after runs and selling after crashes, driven almost entirely by recency bias. Then there is confirmation bias, the tendency to seek, interpret, and remember information that confirms a pre-existing belief. Psychologist Peter Wason first demonstrated this in 1960. But markets make it uniquely dangerous because the internet has made it trivially easy to find sophisticated, well-sourced arguments for literally any position you want to hold. A smart investor does not find one article agreeing with them. They find 17. They build a portfolio of confirmation. And they call it due diligence. Herd behavior compounds all of this. Neuroscientist Gregory Burns at Emory University ran brain imaging studies showing that social conformity, following the crowd, actually changes perception at the neural level. This is not peer pressure in the social sense. People genuinely see things differently when others around them see something different. In a bull market, the crowd is not just tempting, the crowd is neurologically persuasive. Here is something the financial industry would prefer you not think about too carefully. The complexity of modern investment products is not primarily designed to maximize your returns. It is designed to maximize fee extraction, and complexity is the mechanism that justifies those fees. BlackRock manages over $10 trillion in assets. Fidelity, Vanguard, State Street, the numbers are staggering. Active fund management globally generates hundreds of billions in fees every single year. And study after study, S&P's Spiva reports, which have tracked active versus passive performance since 2002, show that over a 15-year period, more than 90% of actively managed funds underperform their benchmark index. 90%. After fees. Financial media feeds this system. CNBC, Bloomberg, the financial press, their business model is not to make you wealthy. Their business model is engagement. Volatility is engaging. Compounding is not. Every day they need a narrative, a reason the market moved, a sector to watch, a trend to position around. That narrative feeds your recency bias. It feeds your herd instinct. It makes inaction feel irresponsible. Brokerages profit from trading. The more you trade, the more they earn. Payment for order flow, the mechanism by which apps like Robinhood made billions, means your trades are literally sold to market makers before they execute. The gamification of investing, the confetti animations, the instant feedback loops, these are not accidents. They are designed to increase trading frequency. Your cognitive biases are not a bug in this system. They are the product being monetized. Retention peak. But here is the part that will actually change how you see money. The evidence for simple beating complex in investing is not marginal, it is overwhelming, and it has been overwhelming for decades. And yet intelligent people almost universally resist it. Why? Because simplicity feels like a failure of effort. If you are a high-functioning professional, your entire identity is built around the idea that harder work and deeper thinking produces better outcomes. That is true in surgery. It is true in law. It is true in almost every domain of skilled human endeavor. But in markets, a complex adaptive system where millions of intelligent people are already incorporating available information into prices, adding your analysis on top does not produce alpha. It produces noise. The market is not a problem you can outthink. It is a system you survive by not reacting to. Warren Buffett's most famous bet was not a stock pick. In 2007, he publicly wagered $1 million that a simple S&P 500 index fund would outperform a portfolio of hedge funds over 10 years, funds run by some of the most sophisticated investors on the planet. He won by a landslide. The index returned 7.1% annually. The hedge fund portfolio returned 2.2%. The smartest money in the world, with every resource and model available, beaten by doing almost nothing. That is the uncomfortable truth this industry has spent billions to obscure. The genuinely wealthy, not the flashy wealthy, the quietly wealthy, share a specific cognitive pattern that almost nobody talks about. They have automated the routine and reserved their decision-making energy for the genuinely rare. They set up automatic contributions to low-cost index funds, not because they lack the intelligence to do more, but because they understand that their intelligence is the threat. They have removed themselves from the decision loop on purpose. They practice what psychologist Gary Klein calls a pre-mortem. Before making any significant investment decision, they ask not what could go right, but specifically how this investment could fail catastrophically. Intelligent investors love a good thesis. Wealthy ones stress test the thesis against its worst possible outcome first. They maintain what Charlie Munger called an inversion habit. They spend more time identifying what not to do than identifying opportunities. They know that avoiding catastrophic mistakes compounds more powerfully over time than chasing exceptional gains. And they treat financial decisions with a specific rule: no significant financial decision gets made in the same emotional or informational context in which it was triggered. They impose a waiting period. A cooling structure. Not because they lack confidence, but because they have earned enough self-awareness to know that their first reaction is not their best reaction. 1. Audit your information diet before your portfolio. For 30 days, track every financial media source you consume, every article, every video, every podcast. Then ask one question: is this designed to inform me or to make me act? If the answer is act, cut it. Your returns will likely improve before you change a single investment. 2. Build a written investment policy statement, your personal rules for how you will invest, under what conditions you will change your allocation, and specifically what events will not trigger a change. Write it when you are calm. Then hold yourself to it when you are not. The document is not a plan. It is a contract with your rational self that your emotional self cannot renegotiate in real time. 3. Introduce deliberate friction into every investment decision. Delete the trading app from your phone. Require yourself to make any non-scheduled trade from a desktop, during market hours, after writing a 200-word justification for why this trade meets the criteria in your investment policy statement. Most trades that felt urgent will never happen. That is the goal. 4. Run a shadow portfolio. Before acting on any investment idea, track it hypothetically for 90 days without committing real capital. This is not about finding winners, it is about forcing yourself to observe whether your thesis holds through one full cycle of good news and bad news. Most investment ideas do not survive 90 days of honest observation. Let the shadow portfolio absorb the losses your ego was about to take. The investor who survives markets is not the one who thinks the hardest, it is the one who has built a system that protects them from themselves. Intelligence is a tool. And like every tool, it can be used to build or to destroy, depending entirely on whether you understand its limits. The most powerful investment insight you will ever have is the recognition that in this specific domain, your instincts are working against you, the system around you is designed to exploit those instincts, and doing less, consistently, quietly, without drama, is the discipline that actually compounds. If this shifted something for you, subscribe, because tomorrow we go even deeper. Next, watch our video on why most people will never build real wealth. Not because of income, but because of a specific emotional pattern around money that gets programmed in childhood and almost nobody ever addresses. This is the wealth code.